For those of you who don't know me, my name's 𝗙𝗓 h_Conway-Hughes, and I'm a financial advisor, but I also do lots of Instagramming, blogging, all those kind of things under the name of Miss Lolly. So you'll see on misslolly.com on the bottom right, and you'll also see our financial advisory company, 𝗪𝗘ci H_Wealth, at the top. And I'm joined also today by Holly. Holly's one of our financial advisors as well, so she's here to support and answer any questions. She'll be monitoring the webinar chat and the Q&A chat. We've already had quite a couple of questions come in, which we'll go through at the end. If you put them in as we go along, if they're related to what we're going to talk about, then I'll do it there and then. And if not, we'll get us through as many as we can by the end of the session. So welcome to today. This is the first in a four-part series, a four-part series, all about money, and it's geared at people who want to be good at money but are really, really busy. So we're going to teach you something, show you how to do it, and then show you how to automate it. And today's session, we're starting with tax planning and pensions. It's not really a usual subject matter to start with when you think about the basics, but I really wanted to do it in this order because of the end of the tax year coming up, lots of planning, but there's some huge problems in the UK when it comes with pensions, which I've just written down. So the first one is the average pot in the over 50s for men is £85,000, and for women that's £39,000. So we've got a gender pension gap. But also the average pot just is not big enough. That's 85 and 39,000 to last you for the rest of your life, not that amount a year. Between 2016 and 2021, so that 5-year period, the Inland Revenue have said that 1.3 billion in unclaimed pension tax relief got left on the table. So that's a huge amount, and we're going to talk you through that as well to make sure you get all the tax relief that you're eligible for. Problem number 3 is there's 31 billion of unclaimed, unactive or lost pensions out there. And we do a huge amount of tracing down old pensions. So we're going to teach you and show you how to get organised with pensions and stay on top of it. And then lastly, between 2021 and 2024, because the tax thresholds have stayed the same, it's meant there's an extra 2 million UK taxpayers who used to be a basic rate taxpayer and now high rate taxpayers. And pensions are a great way to control the amount of tax that you're paying. So let's dive in. I'm going to go reasonably quickly, but if there's anything that doesn't land well, just let us know in the chat and we'll re-explain. The most important thing is that everyone comes away having learned lots. So a little bit about me. I'm a chartered financial advisor. I'm a fellow of the PFS as well, which is just the highest qualification you can get through the PFS. And well, last time I checked, it was about 2% of advisors have this qualification as well. I was IFA of the Year for London in 2022-23, and we're also shortlisted for this year as well for the 25-26 year. So fingers crossed we win. You'll see me hopefully lots in the press, and I also wrote a book for Penguin in 2019 called Money Lessons. So this is us at 𝗪𝗘ci H_Wealth. We're currently an all-female team. That's not how it was meant to be. We've just how it's turned up. But we've really got the best people in the best seats for doing all the bits of jobs that we need to do for clients' plans. And first, before we begin, today's session is just information. There's definitely no advice. Advice needs to be given on an individual basis. And well, today's not advice. So if you could just start, and if you feel comfortable, put it in the chat, anonymously or not, but how do you feel about your money? And we really want to watch over the space of the next 4 sessions, you really increase your confidence. A very common one that we see is that people just don't know where to begin. They're really at the beginning sorting out their money. If that's you, just put a 1 or no idea in the chat. Number 2 is ready to start. So often these people have got bits and bobs sorted, but they don't necessarily have a plan that they're working towards aiming to achieve. The next one is I've got the basics, but I want to learn more and I want to make sure that I'm on track. And then the last one is you're winning. You're on track to achieve all your goals. So it looks like we've got ready to start, done the basics, and a few actually who are on track. Hope those are the ones that are all our clients. Right, let's go. So we're going to start with the beginning of doing anything goal-based. You really need to know what it is that you want. And the more weird and wonderful and the more wacky somebody's financial goals are, the more interesting it is for Holly and I to make the plan. But I just think the more invested you are in the plan completely. So we want to break these goals down to short, medium and long-term goals. A short-term goal is typically something that's going to happen in the next 3 to 5 years. And usually we'll focus for clients on keeping this money in cash. So I've got here an example of someone wanting to build their emergency fund. A real common one is actually wanting to retire, buy a second home, and take that holiday of a lifetime, kids going to a different school. All of those things are very common things that we will help clients plan. And if it's going to happen in the next 3 to 5 years, it's probably something cash-like or cash itself, and that we're going to put clients' money in that section. If we go to the long term, this is usually something that is 10, 15, 20 plus years away. And for our younger clients, it feels forever away, but that is often retirement. It can be helping your parents out. It can be buying that bigger home. It can be downsizing. We see all sorts. I mean, a very common one actually is a change of career. So working really hard now, but want to do something maybe more meaningful, maybe more charitable. That needs to go in the financial plan, because often it can lead to a decrease in your earnings. And then anything in between is this medium-term plan. And the biggest threat to your medium and long-term goals is inflation. So we want to make sure that this medium and long-term money is growing at least by inflation or more. So inflation is the cost of goods and services going up every year. I think we all know what that is now, given the last few years we've been through. Now, I promise you, this is the scariest slide of the whole of today. So if you can stomach this one, you're doing all right. When you've worked out your goals, let's say you've got someone who wants to earn £10,000 a year in retirement, to keep the math simple. You're going to need 25 times that to achieve your goal as a rough benchmark. So for every 10,000 a year you want in retirement, you're going to need 250,000 in your pot. And when I do in-person presentations, this is the one where I suddenly get really big looks from everyone in the room, where the penny drops. Because if you want £40,000 a year in retirement, you're going to need £1 million in assets to be able to retire well. And that's not your home if that's what you're going to want, if you're going to want to live there and not commit to downsizing. So the press always talks about pension millionaires, and that feels like it's something that other people are, but actually it's a good goal for a lot of us to be aiming for if we're going to want that £40,000 a year or more in retirement. And it doesn't just have to be pensions, it can be ISAs, it can be investment accounts, bonds, you name it, but that total number is what we need to aim for. So have a think, and as a rough guess, start to work out after the session, what's your magic number and what are we aiming for? I can see a few clients that are on the call. For you, we've already got it, so don't worry in your cash flow model. So how to get pension savvy. When I first saw this picture, I was like, actually, this woman is the pension savvy. She's got some pearls and diamonds on. So she's the pension savvy one, getting some good advice, giving some good advice away to the lady on her right. So pension contributions. So if you're employed, you pay into the pension. The Inland Revenue, the government's going to pay into the pension in form of some tax relief, and then your employer is going to pay in for some tax relief as well. I don't know if any of you saw an article that I did in You magazine just before Christmas, where we went through all the journalists' pensions and I graded them like a school teacher, and some of them were actually an F. And one of the big things they failed at was their employer offers one pension scheme, but if you pay in a little bit more, you can go into the second pension scheme where the employer will pay in even more. So it's really important to have a look at your pension handbook and see if you pay in more, will you get some more free money into your pension from your employer? Far too many people turn down this free money. And then I'm sorry if this is very basic and it does remind me of a school petri dish, but this is my interpretation. You can tell I didn't do art at school. But what is inside a pension? So the bigger green is your pension. Inside it, you've got funds. And inside funds are lots of different types of investments. So if I've got an American fund, inside there if I have an American equity fund, equity just means stocks and shares. Stocks and shares are just part of a company. It means inside I've got US companies, the stocks and shares of them inside. And a fund manager is going to decide on a daily, weekly, monthly basis which investments they want in and out of their fund. They're going to do that for you on a daily basis, hopefully, be keeping an eye on the market. If you don't do anything, a lot of pension funds are just going to stay in the same fund. So if you're going in and out of the right companies is all dependent on whether you've got a good fund manager or not. And sadly, that's not always the case. So you're going to want to find out which funds you're in, what's inside them. If you are quite ethically driven in the way that you want to invest, you're going to want to see if those investments inside your fund are ethically minded in the same way that you are. And ideally find that perfect match between the funds, what you think, costs and also performance. So things that you need to know. So the annual allowance, this is the amount of money you can pay into a pension between you, the government and your employer. If you're employed by your own limited company and you're making contributions, ideally you want to be making those contributions as an employer contribution going directly in. It comes out before tax, personal tax, and it saves you corporation tax. So that's the total amount that you're going to be allowed to pay in as an employer's contribution. But the total amount into the pension can't be more than £60,000 a year. Used to be 40 in the past, but during the pandemic, the government increased it to 60,000 to encourage lots of those doctors to stay in the NHS. If you are extra keen on pensions and are maxing out in this tax year, sometimes people don't realise this, but you can actually go back for the last 3 tax years and pull forward any unused allowances. The most important thing is you must have had a pension at some point in time. So if I only started my pension this year, I can't go to back to the last 3 tax years. So you fill the year that you're in first, and then you go back to the 3rd tax year in history and fill that one, and then the 2nd, and then the 1st. A really good example of this was we had a client whose business suddenly took off around this time last year. And he said, I've never had a pension. And I was like, that's such a shame because we can only do the year that we're in. However, with a bit of digging around, we did manage to find a pension from his very, very first graduate scheme. There's only £3,000 in there, but it did mean that we could do the current tax year and the 3 previous tax years. So his company was able to do a really big pension contribution in and save 25% corporation tax. Just had a question that come through, which probably affects a few. So as a freelancer, I take money out of my pension. Should I take this before or after taking my taxes? I'm not sure of the question, sorry who wrote that one, but I presume, so if you're a freelancer, the best way to arrange your money is it's all going into one bank account. The first thing you want to do is set aside your taxes and your NI, and your accountant's going to help you with that number. And then you're going to want to, out of the money that's left, then pay a pension contribution. I'm going to teach you how to work out what tax you're due, but as a general rule of thumb, if you're earning less than 50,000 a year, for every £80 you pay into a pension, the government's going to pay another £20 in. So you get your equivalent of 20% tax relief. And another lady's just asked, if you're self-employed, it works exactly the same as a freelancer. You're going to you're going to pay out of your net earnings, and then the government will top up if you're a basic rate taxpayer with 20%, and then you're going to let your accountant know if you're a high rate taxpayer, and they're going to claim the rest back for you. For those of you who are interested as well, we are doing one of these series just for people who are self-employed, coming up. The first one is February, so look out for details of that if you're self-employed or employed, because we've got lots coming your way. We did a lot of people in our client base run their own business, and they asked for these specifically. So how income tax works: so the first £12,500 that you earn, you pay 0 tax on, and this is called the personal allowance. Look out for that in any budget. Recently, it's been going up by quite a lot over time, so that's quite good. Basic rate taxpayers are those people paying 20% tax, and you pay tax on 20% between that 12,500 of earnings and just over 50,000. Then the high rate tax threshold starts. So at 40,000, you're paying, between 50 and 100,000, you're paying 40% tax, and there you're a high rate taxpayer. And then between 100 and 125, you're paying this dreaded 60% tax. And someone has just asked, that's confusing, why does it happen? And it's just because I think the government can think they can get away with it. And then this higher rate tax threshold kicks in at 45%. The technical reason why there is that 60% tax threshold is that for every pound you earn over 100,000, you lose 50p of your personal allowance. So it creates this 60% tax bracket on the top. And then these are the tax traps that you need to be really aware of. So if you've got kids and you earn over £60,000 a year, you fall into this child benefit tax trap. So if one of you earns more than £60,000, you're going to get some child benefit as long as you earn less than 80. But the minute you earn over 80, you get 0 child benefit. Then the next one is this 60% tax threshold, the higher earning charge that we talked about, where you lose that personal allowance. So just be really aware of it and think about which bracket you fit into, because I'm going to show you in a minute how you can pay in a pension to control the tax bracket that you actually end up in. And it's completely legal, nothing weird or wonderful about it. It's very, very simple tax planning when you can get your head around it. So this is how to legally, in bold, manipulate your tax. So let's say I'm earning £15,570 a year. If I paid, and I mean, you'd have to, well, you couldn't be eating beans, but if I paid the whole amount in that I earned into pensions, the benefit is I could actually pay £15,570 in pension, of which 20% is tax relief. So I could be getting tax relief on money that I actually haven't paid tax on, because I'm only paying tax between that 12.5 and the 15.5. So it's a brilliant way. I just did an annual review for a client today. He's an additional rate taxpayer. His wife is a basic rate taxpayer, and we just pay all the money in her name into a pension to get that 20% tax relief back on money where she's not actually paying tax. It feels very satisfying. The next example is this 60,270, if that's what I'm earning. If I pay £10,000 gross into a pension, which is £8,000 out of my pocket, or I sacrifice through my work scheme £10,000 into my pension, I'm going to reinstate myself back as a basic rate taxpayer and get all my 40% tax back. The next one is if I was earning 125,000, obviously if I put £25,000 gross into my pension, I'm getting all that 65% tax back, which will reinstate me back in that 40%, which is huge in that scenario. And then I've put one here at 180. I know that's a very, very high earning amount of money, but it's something we come across a lot. And there's just some ideas. So I'm only allowed to pay £60,000 a year into my pension. But I ideally want to pay £80,000 into my pension in this example, so that I get all my 60% tax back. So first of all, I'd look back to see if I can bring forward any allowances to mean that I could do my 80, and that might not be affordable, or there may not be those allowances to carry forward. But what you could do is plan it well, so that every second year you could do your 80,000. Because you're using your unclaimed allowances, and it means you're being reasonably tax efficient in year 1, but extremely tax efficient in year 2, because we're managing to get you into that £100,000 threshold. When changing your tax code, your tax bracket, you just need to be careful for things like pensions and any benefits at work, in case they're on your adjusted salary rather than your gross. But yeah, chat to your mortgage broker about that too. Somebody's just asked, can salary sacrifice work when you're self-employed? It can work in that you can change your earnings, you can change the threshold where you actually end, but you wouldn't be able to use salary sacrifice, because salary sacrifice is giving up salary straight into your pension before you pay tax. As a self-employed person, you're going to pay in out of your income, going to get the 20% tax relief back. Like you pay in 80, the government pays in 20, and then if you're a high rate taxpayer, through your tax return you're going to get another 20 back. So it means in the end you've paid 60 and the government's given you 40 back. So that's how you'll do it. So how to improve your pension? So I hope this isn't too simplistic, but paying more. We constantly are giving clients a little nudge to see if we can get them to pay in that little bit more into their pension. We can get better net performance is another way to increase it. And by net, I mean after costs and charges. There's no point you'd need to compare very clearly an expensive, well-performing pension with an average, very cheap pension to make sure which one actually was you were better off with. And then another lever that you can pull is actually retire that little bit later. Clients are often really astounded by the impact that retiring that little bit later can have. Depends on your age and your circumstance and what you're trying to plan. But if someone, say, wanted to retire at 55 versus 60, my rough guess is they'd need 20 to 30% more because of those 5 years of extra payments out, but those 5 years of missed contributions as well. Somebody's just asked that I'm a landlord and self-employed with a salary of 48. How much can you pay into a pension? This one's too tricky for me to answer, but you can only pay into a pension earned income. So if you're a holiday let landlord, there's very different rules, but assuming you're a buy-to-let landlord, you can't pay in your income from being a landlord into a pension. So this example, the lady's she's being taxed on 125,000, but her salary is 48. Ideally, you could put in 48,000 into your pension and get tax relief. And that's going to take your earnings from 125 down to 177, if my maths is right. Sorry, not 177, to 77 to get your contribution, or your 40% and your 60% back. Okay, so on your to-do list, this is sort of like cleaning the decks, so that once all this is done, it's then just about maintenance. So number one is track down your old pensions. I'm quite ashamed by my Canva techniques on the right here, but this is me copying and pasting the pension website you need into the iPhone, and I can see that I've missed it around the edges. But you just need to go on to the government pension tracing service and go back and look at every single employer I've ever worked for and track down those pensions. And as a reminder, there's 31 billion of unclaimed pensions out there. Very, very commonly, Holly and I are finding 5, 10, 15, 30,000 pounds of pensions that clients had completely forgotten about. But if you want a carrot to dangle in front of your nose while you're doing all of this admin, I once did find pensions that went all the way back to the 80s for a man that totaled over £1 million, and he was expecting there to be a couple of hundred in there. So do make sure you go back and claim them, and there's going to be a follow-up after today with all the templates you need, so you can send them off and order all the correct information that you're going to need to be able to analyse your pension. The next thing is you really need to get informed. So please don't be intimidated by your pension providers. They really are there to support you, and don't forget you pay them through your pension fees. So you want to find out from them what funds are you in. If you remember my Petri dish diagram, there could be a couple, there could be 10, there could be 15, and you want them to send you the fund fact sheet so that you can see actually what's inside of those funds. They'll usually show you the top 10 holdings that's inside. You want to know really clearly about the charges. If you just phone up a pension provider, it can be really hit and miss depending on who you get and how knowledgeable they are at the end of the phone. So you want to ask a specific question: is what is the total expense ratio, so the TER of my pension, and that's going to tell me all the costs and charges rather than just the headline rate. So yeah, you want to know the costs, and you want to look up the returns. And then you want to calculate your ideal contribution. So if you could add these 3 things to your to-do list. The ideal contribution comes from a tax planning point of view. So what's the ideal amount for you to control your tax and your tax threshold? But also it comes from that bigger picture goal planning point of view. There are, I have no allegiance to this provider, but one that naturally comes to mind would be Standard Life or Aviva. They have got quite good pension calculators on their websites where you can put in your age, what you're paying into your pension now, what it's worth now, and project forward what you're likely to get if you want to use that as well. We've got questions coming in fast and furious here, so I'll just answer a couple as we go along so Holly can stay on top of them. So the first one is, if you live and work abroad and are a UK citizen, can you pay into a UK pension? Is this my sneaky client that we're trying to get the answer for on this one? I think it might be. It really, really depends, and we have to take advice from the Inland Revenue and accountants on this. The answer is it really depends on your situation. I'm sorry that that's not helpful, but I am trying to find out this for another client if it's not you. And yeah, I don't know is the honest answer. It depends. The things that the accountant was saying really is it depends where you're resident in the tax year, where your company is based, and lots of things. But you need a team that can help you answer that question. Is it a good idea to make use of children's pensions to be tax efficient? I think it's the same scenario. You know, people always say put your own seatbelt on before you put the kids. That's on an aeroplane, not a car. But if you, I think you've got to be on it with your own pensions before you even start considering about your kids' pensions. But the old rule of thumb was if you put the child benefit into a pension for a child between 0 and 18, and it grows quite high, probably at 8% was the number, then the child then didn't contribute anything else to a pension, that they'd have £1 million pension pot by the time they got to 65. So I do pay into a kid's pension for my kids, but I only do £50 a month. I don't do anything massive, but I just feel like I'm doing a little bit for them. Kids, well, unless you set them to work, my kids are still at primary school, so they're not earning, but they still do get 20% tax relief paid into the pension. And nil rate, people who don't earn at all, so kids or those who aren't earning, you can still pay into a pension. You can pay £3,600 a year, which is obviously £300 a month, and that's the gross amount. So out of your pocket, you pay £240 a month as an absolute maximum. And then next one is, should you consolidate all pensions or leave them separate so it's more diversified? Pension consolidation is really not an easy thing to get right. You want to, in the templates that are going to come out after today, there's going to be a spreadsheet that you can fill out to compare your pensions. But the things that I'm looking for are variety of funds that a client can be in, past performance, although that doesn't indicate that they're going to be good in the future. But I do want to look at past performance. I also want to look at costs and charges. I also want to be really, really careful. So, for example, last year we came across a client who had 2 pensions that had protected tax-free cash. So most people can have 25% tax-free cash, but he had over 90% tax-free cash. And if we'd moved the money, he would lose the protection. So again, in the handouts that you're going to get, we've clearly written all the questions about guarantees that you can ask the pension providers so that you can be alerted to it. Because if you move a pension and it's got these guarantees, often you've lost them and they're gone forever. So yeah, it's a variety of things. But I think a lot of people do like to have that consolidation, mainly because of admin ease. So can you get tax relief on payments into a junior ISA? So the answer is no, sadly, for that. But when the money goes in, the money can grow tax efficiently. So you don't pay any tax as the investments are growing. And then I'm just going to keep going for momentum, and then I'll come back to more questions because I think we're probably getting more than we could ever answer. So let's see. So if you add this to your to-do list, I'm sorry if it sounds bossy, but most people do need to do this. And then I'm going to show you how to automate it in a second. So first of all, why it's important. And this is me looking, if you've got 10 years, 20 years, 30 years, 40 years, and this isn't until retirement, this is to live, because your pension ideally is going to last you throughout your whole life. And you've got a 3% return, a 5% return, and a 7% return. You can see the difference just in the 10-year calculation. Getting this right over 10 years, say you got 3% versus 7%, that's an extra £60,000 in your pot. We're talking about numbers that start to change significantly the standard of living that you're going to have in retirement. But the earlier you do this, the better, because the more you can get your pension working hard for you in a very efficient way, i.e. the funds are working well, the charges aren't too ridiculous, and you've got a system where you're being alerted to if the funds start performing badly, so you can make changes quickly and get this working hard for you. You look at the difference between 40 years, it's just absolutely bonkers. £300,000 in your pot versus 1.5. I mean, it's insane. So getting this right is really important. And this was about starting with £100,000 in your pot, and this with no further contributions. I did the same calculations just because I can't help myself. But if you paid in £500,000 into the pension, what would you get? And that just magnifies the difference even further. So getting this right and making sure that your pensions are working hard for you, a 2% or a 4% difference over a long period of time is just going to transform the retirement standard of living that you have. And also probably having excess, and going into retirement having excess means you can retire earlier, you can make bigger gifts, you can go on those bigger holidays that maybe you didn't think you'd be able to do, or just not have to downsize as well, which is lovely. Okay, so now once you've cleared the decks and you've worked through all the handouts that are going to come out afterwards, you then want to set reminders. Now, I sometimes feel like my mum when I'm on my phone, but I found this YouTube video here, and I'll put this in the email that will come out afterwards, so you can just click on the link. But this was a really good, I think it's only 7 minutes long, a video of actually how to use reminders on your phone really, really efficiently. And you don't even have to type them, you can just say it and it'll still set the alarm, the alerts for you. But I'd really love you, in whichever way you can, set reminders so that you're reviewing the funds every 6 months within your pension. So as part of the sort of clear the decks, you'll have a list of the funds that you're in. And then there's a website called trustnet.com. And if you every 6 months, just put it in your diary to check those funds. You'll see on trustnet.com there'll be a graph, and on that graph, one is you, one is the average, and that's just a bit of an acid test to check how it's performing. If things are changing a lot or you're starting to really underperform, then that would be a good time to get in touch with an advisor. And you'll also see on there some numbers, the percentage growth over 1, 3, 5 year. At the very bottom of that table, you'll see either 1, 2, 3 or 4. If you see 1, it means you're in the top quartile, so in the top 25% of funds. And really that's all we're trying to do as advisors, is get clients in that top echelon of performance. You're never going to be number 1 year in, year out. It's just impossible. Number 2 means in the top 50%. 3 means the top 75. So you're in the bottom 50% of performing funds. And I would argue, why are you parting with your money to be in a fund that's in the bottom 50% of funds? And then the fourth, the quartile, you really want to make sure you're avoiding those. So trustnet.com is the resource that you can use for that to analyze the funds, or you can just ask the provider for the fund fact sheet every 6 months, but they're not going to show you that quarterly, that quartile analysis. Next one is review your contributions. And so you want to put it in a reminder in just annually. So maybe it's every January you decide to up your pension that little bit more. But you also want to review your pension when you get a pay review, when you get a bonus, but also when your work pension window is open. So many clients, we want to do really good pension planning. Let's say they come in for, they first get in touch in October, and we'd love to try and do some pension planning before the end of the tax year. Often we can't because the work pension window won't open till April, let's say. Some companies are very flexible and you can make changes at any time, but that's a really important one to put in your diary if you have a slightly less flexible employer. So once you've got these reminders in your diary, or however you're going to do it, you can then do it once a year. The reviewing your funds literally is a 10-minute job, unless you need to make some changes. The reviewing your contributions and pay, that's probably a half-an-hour job. And then the pension window opening, that's a 10-minute job as long as you've done point 2. So, and then you can forget about it. You can wipe it off your mental to-do list and it's done. So I'm going to go through the questions, but also if you could, for your own sake, write in the chat, what's the biggest takeaway? What's the thing that you're definitely going to do today? What are you going to do this week? But also what you're going to do by the end of February, so that you can really hold yourself accountable to make some changes, because it's going to come around quite quickly the next session, I'm sure of it. And that's where, and there's some prep for the next session. So we've got loads. Honestly, I love this. You're also proactive. My biggest takeaway is that everyone on this call is very organised. And there's no hidden agenda from Holly and I in all of this. We just got some feedback from clients that clients really wanted to understand the basics of financial planning and financial management well, and this is why we've put on these webinars. And we thought, well, why would we not just open them up to everyone? We had a whopping, I can't remember the number, was it, I might be over-egging, but it was more than 200. I think it was actually nearly 300 people signed up for today. So we can really see that there is a need for this. Okay, so the one that's coming on the 29th of April, I'm really excited for this one. This is, we're going to go perhaps to the real basics, which you probably thought you were going to be learning about today. So sorry to trick you into pensions, but we're going to do budget tips that you can stick to, how to automate your money on a monthly basis so that it just happens, so that it's harder to be bad with money than to be good. I'm going to show you how to plan for regular expenses and also regular income. I notice there's lots of freelancers on this session today. And I'm going to talk to you about emergency cash buffers, whose name to put them in, what to look out for, how you're taxed on them so that you can be smart with them. So that's going to be the 29th. And how to prepare. So when you register for this session, the details will all come to you in advance so you can prep, but you'd need to, if you want to get the most of it at least, is to complete the budget planner. So this is what you've got coming in, what you've got going out, and don't just do a 5-minute before job. The more information and the more realistic it is, the more you're going to get out of it. There'll also be an assets and liability template for you to fill out so that you can track it every month and monitor your progress. And then have a bit of a think about those scary goals we thought about at the beginning, which was the 25 times. How we can help. So the idea of the 𝗙𝗏𝗏.com is, well, firstly, I need to change my photos because I never catch myself at the beginning of a video very well, but who cares? But the idea of 𝗙𝗏𝗏 is that I put out a snippet of information that you can action upon or learn from, so that over the course of the year, you're really building your financial knowledge. We go into a bit more detail into the fortnightly newsletters. You can sign up to the newsletters on 𝗙𝗏𝗏 or the 𝗙𝐶H website. And we, I came at the newsletters really from the back end, which was I told the journalists who write them that I want the client to feel like by reading it, they're at least £500 better off. And sometimes the content that comes out doesn't achieve that goal, and so we have to rewrite it. So I really have written them from an angle of, if you do this and if you read it, you're going to be better off. And then lastly, Holly and I do 10 financial diagnosis sessions a month. They do get booked up, and I'll explain about those in a minute. The session after that is get organised. So we're going to talk to you about what you need to do every month to stay on top of your goals, what to do at the end of every month to plan for success that following month. So we're going to allocate a big to-do list, a big financial to-do list over the year into monthly bite-sized chunks. So if you do one job a month, then you're going to be on top of your whole financial planning. It'll be quite, hopefully, financially liberating. And we're going to show you what to keep, where to keep it, and for how long, and so that you just don't have paperwork everywhere. And then I've got some bigger picture planning tips, and also a list of all the books that I think would be very good to read if you're really committed to learning lots about money. And then the last one is the investing masterclass. We're going to cover what investments all the investment jargon really that's out there, what to do if you get a windfall, and the 5 mistakes that I see and how to avoid them. And then this is quickly, before I do the answers, all about a financial diagnosis session that we do. So when we do them, we build in that hour live with you, cash flow modeler, and this is the basis of all clients' financial plans. But you will come away knowing how much you have to save every year to achieve your goals, what you're on track for to spend already if you did nothing else, the investment returns that you need to achieve every year throughout your life to make sure that you're on track, or what additional lump sums you need to save. So that just knowing those 4 things are often all people need to actually go and then start their financial planning themselves. So it's us giving a little bit of guidance to kickstart your plan. So I'll go through the questions. If anyone's got to leg it, because I know we've taken a little bit more than we thought, but I'd like to go through all the questions if I can. We've got Another one, so a slight segue, but is it possible to invest your money inside your business rather than invest once you have taken out? So if you're a business owner, we do invest money that's inside of a business, but we have to do so in conjunction with an accountant to make sure we get it right. And things that accountants always bring up is that if you're investing lots of money in your company, you might not meet the rules to get the relief when you sell your business. So often clients may have a holding company that, say, is an investment company where we keep their money, especially if they've had a recent big sale or they're making a lot of profit that can justify those extra accountancy fees. But the answer is yes, but we've always just got to be careful and make sure we do it in the right way. Once you earn over 125,000, are there any childcare savings you can make, help that you can get? I don't think so, I'm afraid. Not that I know of. I think it's that 100,000 is the limit. I don't know if you'd agree, Holly, but I think you've got to get below that 100,000. Where do you go to set up a pension as a self-employed? So you might have some pensions already that you can top up, and that will allow you to make a personal contribution, because if you're self-employed, you are making a personal contribution into that pension. You can look at, there's lots of comparison sites out there for pensions. You can look out on the Times Money Mentor as well. You've just got to be careful, because often some of those really cheap pensions only give you access to 3 or 4 funds, and then those 3 or 4 funds are actually really rubbish. So make sure you're not being led completely by cheapest cheerful. But also something that I see often, especially with these pension consolidation companies where they're wanting you to get your pensions from here, there and everywhere and consolidate under them, is, let's say that, well, an example I saw recently was one of these companies was charging, I think it was 0.63%. I think that was the amount. But when I dug a bit deeper, inside it, they had a legal and general fund. And that legal and general fund was a 0.12% charging fund. So it was so cheap. So yeah, just be careful, because sometimes pension providers can add a lot of fat on for their margins where they're not necessarily working hard for it. Would you say it's best to invest more in pension or buy-to-let properties for the longer term? I think if you're really good at buy-to-lets, then you could do really well. I think the government is making it harder to make buy-to-lets work, mainly because they don't allow you to do any pension planning with them, with the income, and the stamp duty that's just increased, and also the way that the tax calculations work now. It used to be income minus mortgage equals profit, which makes sense, and then you're taxed on your profit. But now you work out the tax on the income and then you get a credit for the mortgage relief. And also mortgages just aren't our friends right now. Or we're just going to have to get used to them being at this rate. So that can work against you in the current climate. So I would think about that. And I think another downside is also liquidity. It's really hard to sell a property, but I could sell a pension. I could sell someone's pension and have the money with them within 5 days. So I think if you're leaning towards doing some property, I think do a bit of both. I wouldn't just do property, but I've got lots of clients who do just do pension as well. So somebody's asking about a US-based accountant, if they can help. If you need help with some UK-US stuff, we don't have the license to do it, but we know some really good people in the industry that do, that we can put you in touch with. And then let me see, I think some questions might have come in on the chat. So would it be possible to advise me on an accountant as a limited company, please? So on the limited, well, my accountant, I use Faye and Steve at Fuse, so you can look them up. They're based in Highgate, but also Faye is doing with me the business sessions that are coming up from February, so you can see her on there. But what I really like about her is she just talks in normal English and I understand what she's going on about, which is always helpful. And then next question is, how much is a consultation? Oh, so £350 is the price of the financial diagnosis session. The way that we designed it was that the £350 is also deductible against any future advice costs. So if you become a client, we take that off your fee anyway. Lady says, I'm employed and have a joint property with my husband. My share of total income is between 100 and 125. So I came across a couple last week, with exactly the same situation. The husband was a high earner, the wife was a basic rate taxpayer. By removing the husband, not completely, but doing what's called an interspousal transfer and reducing his share of the property, and so more rental income went to the wife, we were able to save them £27,000 a year in tax, which was just bonkers. No, I think I got that wrong. That was over 5 years, sorry, but still bonkers amount. Always very helpful. So the next, we've got lots of ladies on here, which I love. I've rung and changed my pension with Legal and General to a global fund, risk for. Oh, this is what to do. Well, this person sounds very knowledgeable. I love that. Here we go. I'll go down to the next questions that I've missed.
Should we count one?
Have I missed one, sorry?
There's one that says, if a company has changed name since you worked for them, should you search the old or new company name when searching for old pensions?
What would you say, Holly? Would you just do both to be sure?
Yeah, I think you could start with the name of the company when you worked there, because that's more likely to come up with the pension scheme for when you were actually there. And if not, you can say you're not sure on the name, and then you can use either the new one or the old one.
And the template we've got, I mean, it would be an extra 1 minute job just to change the address and send the letter out to both anyway, wouldn't it? Just to be sure.
Yeah.
Are there any others that I missed?
And there was just one saying, advised by a friend to add 1% to my pension every year. I'm not sure what that 1% is of salary.
Maybe it's 1% more.
Yeah. Is that good advice, is the question?
I think it can always help close that gap by just doing 1% more. You're probably not going to miss that 1% hugely, but it will have a big impact over your life. But we saw as well, if you can't pay in anymore, making sure you're getting the right the right returns for you, just increasing your returns by a couple of percent a year can transform your pension planning. Then we got some more. With penalties for leaving a pension provider, is it best to wait until the penalties stop before leaving? So I can already guess which pension provider this is, I imagine, because we come across these all the time, and it really depends. So a very, very good example was the difference in cost between the old pension and the new pension was about 1%. And often these pension providers, if it's the one I'm thinking about, the penalty goes 5%, 4%, 3%, 2%, 1%. So because it was a big amount, we waited to move until year 2, where the penalties were 2%, mainly because we justified it, because we felt the performance gave us, past performance gave us confidence that we could hopefully get better performance going forward. 2% didn't feel that psychologically a big penalty is 3%, but if in doubt, you could wait till the final year where you move with a 1% penalty if there is that 1% difference in costs. How do we find out about the self-employed sessions you mentioned? I'll make sure it goes on the email out to everyone afterwards, but it's a Zoom link that will come out. Now, was there any other questions? Oh, would you go for ISAs for children rather than pensions, or as well as? It's really hard. I think one reason why I just went halfway and did a little bit into pensions, a little bit into ISAs for each kid, mainly because I think that generation are going to have pension problems. All over the newspaper this weekend was Steve, I can't get Steve Jobs out of my head. The old pension minister anyway, Steve someone. he'll come to me saying he doesn't think the state pension's going to be around in the same capacity forever, and it maybe means tested. So I think that's going to be a bigger problem for that next generation. But also, I didn't want my kids to have too much money in their 20s. Imagine if you could save £9 a year into a junior ISA, there's going to be some very rich 18-year-olds. I'm not sure I'd trust the 18-year-old version of me with that amount of money. So yeah, I've done a bit of both, just to hedge my bets. I think that may be it. Have we managed to go through? Oh,
there's more in the chat. We had a couple before the session as well. Do you want me to read those?
Oh yes, please.
So this one is someone that started their final salary pension when they were 18, now 39. They put 6% in and their employer matches with 12. There's an option to do an additional voluntary contribution and they earn 60 to 70,000 a year and also save into a stocks and shares ISA. Should they add into the additional scheme? And what percentage would be a good amount, or just better to pay into that ISA?
So, I mean, if I was still grading this person, I'd say A star, because to have that final salary pension from 18 all the way to now is incredible. So I would approach it in two ways. Number one is what is it that you want in retirement? Maybe that pension, whilst it's amazing, maybe it's got a later retirement date than when you'd actually prefer to retire. So you could contribute more into a pension to get the tax relief so that it gets you to that 50,000 threshold, maybe, if that's not too much. But that could be your tool to retiring earlier. So a lot of these defined benefit pension schemes probably have pension ages of 65, 67, and you can take them earlier, but if you do, you'll be penalised, usually by about 5% a year. So if you've got your own pot, then that could be a good thing. But in the terms and conditions, I'd just check if you're going to put into an ABC, do you have to retire completely from the DB pot, from the work, before you can touch the ABC? So I do a little bit of research, but yeah, I think if it's for early retirement, I think it's a good idea.
Someone's asked about signing up for the other sessions. Is there going to be a link for that?
Yeah, I'll make sure I put it on the email that will go out to everyone after today with all the sessions. Was there a second one at the beginning? I think we got in advance.
Yeah, and it was just saying that they've worked for small companies or been self-employed. They're now they've now got their own limited company since 2017. They want to start saving for their future. What's your advice on this and how to go about doing it?
So we'll cover this more in the other sessions, because often when you're just starting out self-employed, your income's really variable. But I would do a monthly amount that's slightly painful, but you know you can afford it, and then do the quarterly or 6 monthly reviews and do some lump sums in. Some of those old pensions might allow you to pay in if you don't have a self-employed pension yourself. I can't think of anything else. Can you, Holly? Put you on the spot.
Yeah, I know. Sorry, I was busy reading the other questions.
Review the funds that you're in if you've got a few scattered around. That could be a good thing. And I think if you're not coming to the self-employed session with us, then just make sure you get some income protection, because see, there's no safety net. That would be a top tip. And if you need an intro into anyone for the income protection, we've got a great lady. So I happily send anyone her details who contacts me.
Someone's asked about Nest as a pension provider.
Yeah. So we probably don't have a choice to be in it if it's what your company's given you. If you pay your own money in above that into Nest, think it's a 0.3% initial fee. So if you're paying lump sums in of your own money, that might put you off. It has got limited pension choice. And there's a bit of hoo-ha around it at the moment, in that there isn't a 100% equity pension fund anymore. The Sharia fund used to be the 100% equity fund that you could pick, whether you were Muslim or not, but now that's no longer 100% equity. So they don't, for those of you who are young or wanting to take high risk, that Nest pot doesn't necessarily have that option anymore. But you can just look up, go to trustnet.com and just look up all the Nest funds, because I think there's only 6 or 7 that you can pick from, maybe actually 5. And then someone said People's Pension as well. On my to-do list, which is never ending of content to supply, is a fact sheet on Nest and People's Pension. It is on Elena's job. It was on Elena's job for January, so let's see if she gets it done. Don't want to put too much pressure, but it will come out soon, because I think it's really needed. I don't think they're bad at all, and I think you just need to get your head around when to use them and when not to use them. Well, it's 2 o'clock, so we best go. But thank you everyone so much for coming. Honestly, it was so lovely to have everyone come. We just couldn't believe how many people signed up. We thought we might get my dad and my mum, and maybe Holly's mum and dad to us. So thank you very much.
Thank you.
Bye.